The Capital Structure Puzzle by Stuart C. Myers in the Journal of Finance, July 1984. This paper's title is intended to remind you of Fisher Black's well known note on the dividend puzzle, which he closed by saying, "What should the corporation do about dividend policy? We don't know." I will start by asking, how do firms choose their capital structures? Again, the answer is we don't know. The capital structure puzzle is tougher than the dividend one. We know quite a bit about dividend policy. John Lintner's model of how firms set dividends dates back to 1956, and it still seems to work. We know stock prices respond to unanticipated dividend changes, so it is clear that dividends have information content. This observation dates back to at least Miller and Modigliani in 1961. We do not know whether high dividend yield increases the expected rate of return demanded by investors, as adding taxes to the proof of dividend irrelevance suggests. But financial economists are at least hammering away at this issue. By contrast, we know very little about capital structure. We do not know how firms choose the debt, equity, or hybrid securities they issue. We have only recently discovered that capital structure changes convey information to investors. There has been little, if any, research testing whether the relationship between financial leverage and investors' required return is as the pure theory predicts. In general, we have inadequate understanding of corporate financing behavior and of how that behavior affects security returns. I do not want to sound too pessimistic or discouraged. We have accumulated many helpful insights into capital structure choice, starting with the most important one, MM's no magic in leverage theorem, proposition 1. We have thought long and hard about what these insights imply for optimal capital structure. Many of us have translated these theories or stories of optimal capital structure into more or less definitive advice to managers. But our theories don't seem to explain actual financing behavior, and it seems presumptuous to advise firms on optimal capital structure when we are so far from explaining actual decisions. I have done more than my share of writing on optimal capital structure, so I take this opportunity to amend and to try to push research in some new directions. I will contrast two ways of thinking about capital structure: a static trade-off framework, in which the firm is viewed as setting a target debt to value ratio and gradually moving toward it, in much the same way that a firm adjusts dividends to move toward a target payout ratio. Number two, an old-fashioned pecking order framework, in which the firm prefers internal to external financing and debt to equity if it issues securities. In the pure pecking order theory, the firm has no well-defined target debt to ratio. Recent theoretical work has breathed new life into the pecking order framework. I will argue that this theory performs at least as well as the static trade-off theory in explaining what we know about actual financing choices and their average impact on stock prices. Managerial and neutral mutation hypothesis. I have arbitrarily and probably unfairly excluded managerial theories which might explain firms' capital structure choices. I have chosen not to consider models which cut the umbilical cord that ties managers' acts to stockholders' interests. I am also sidestepping Miller's idea of neutral mutation. He suggests that firms fall into some financing patterns or habits which have no material effects on firm value. The habits may make managers feel better, and since they do no harm, no one cares to stop or change them. Thus, someone who identifies these habits and uses them to predict financing behavior would not be explaining anything important. The neutral mutations idea is important as a warning. Given time and imagination, economists can usually invent some model that assigns apparent economic rationality to any random event. But taking neutral mutation as a strict null hypothesis makes the game of research too tough to play. If an economist identifies cost of various financing strategies, obtains independent evidence that the costs are really there, and then builds a model based on these costs, which explains firms' financing behavior, then some progress has been made, even if it proves difficult to demonstrate that, say, type A financing strategy given higher firm value than a type B. In fact, we would never see type B if all firms follow value maximizing strategies. There is another reason for not immediately embracing neutral mutations. We know investors are interested in the firm's financing choices because stock prices change. When the choices are announced, the change might be explained as an information effect having nothing to do with financing per se. But again, it is a bit too easy to wait until the results of an event study are in and then to think of an information story to explain them. On the other hand, if one starts by assuming that managers have special information, builds a model of how that information changes financing choices, and predicts which choices will be interpreted by investors as good or bad news, then some progress has been made. So this paper is designed as a one-on-one competition of the static trade-off and pecking order stories. If neither story explains actual behavior, the neutral mutations story will be there faithfully waiting. The static trade-off hypothesis. A firm's optimal debt ratio is usually viewed as determined by a trade-off of the cost and benefit of borrowing, holding the firm's assets and investment plans constant. The firm is portrayed as balancing the value of interest tax shields against various costs of bankruptcy or financing embarrassment. Of course, there is controversy about how valuable the tax shields are and which, if any, of the cost of financial embarrassment are material. But these disagreements give only variations on a theme. The firm is supposed to substitute debt for equity or equity for debt until the value of the firm is maximized. Thus the debt-equity trade-off is as illustrated in Figure 1. Cost of adjustment. If there were no cost of adjustment and the static trade-off theory is correct, then each firm's observed debt-to-value ratio should be its optimal ratio. However, there must be cost and therefore lags in adjusting to the optimum. Firms cannot immediately offset the random events that bump them away from the optimum, so there should be some cross-sectional dispersion of actual debt ratios across a sample of firms having the same target ratio. Large adjustment cost could possibly explain the observed wide variation in actual debt ratios. Since firms would be forced into long excursion away from their optimal ratios, but there is nothing in the usual static trade-off theories suggesting that adjustment costs are a first-order concern. In fact, they are rarely mentioned. Invoking them without modeling them is a cop-out. Any cross-sectional test of financing behavior should specify whether firms' debt ratio differ because they have different optimal ratios or because their actual ratios diverge from optimal ones. It is easy to get the two cases mixed up. For example, think of the early cross-sectional studies which attempted to test MM's proposition 1. These studies tried to find out whether differences in leverage affected the market value of the firm or the market capitalization rate for its operating income. With hindsight, we can quickly see the problem. If adjustment costs are small and each firm in the sample is at or close to its optimum, then the in-sample dispersion of debt ratio must reflect differences in the risk or in other variables affecting optimal capital structure. But then, MM's proposition 1 cannot be tested unless the effects of risk and other variables in the firm value can be adjusted for. By now, we have learned from experience how hard it is to hold the other things constant in cross-sectional regressions. Of course, one way to make sense of these tests is to assume that adjustment costs are small, but managers don't know or don't care what the optimal debt ratio is and thus do not stay close to it. The researcher then assumes some usually unspecified managerial theory of capital structure choice. This may be a convenient assumption for a cross-sectional test of MM's proposition 1, but not very helpful if the objective is to understand financing behavior. But suppose we don't take this managerial fork. Then, if adjustment costs are small and firms stay near their target debt ratios, I find it hard to understand the observed diversity of capital structures across firms that seems similar in static trade-off framework. If adjustment costs are large, so that some firms take extended excursions away from their targets, then we ought to give less attention to refining our static trade-off theories and relatively more to understanding what the adjustment costs are, why they are so important, and how rational managers would respond to them. But I am getting ahead of my story on the debt and taxes. Debt and taxes. Miller's famous debt and taxes paper cut us loose from the extreme implications of the original MM theory, which made interest tax shields so valuable that we could not explain why all firms were not awash in debt. Miller described an equilibrium of aggregate supply and demand for corporate debt, in which personal income taxes paid by the marginal investor in corporate debt just offset the corporate tax savings. However, since the equilibrium only determines aggregates, debt policy should not matter for any single tax-paying firm. Thus, Miller's model allows us to explain the dispersion of actual debt policies without having to introduce non-value maximizing managers. Trouble is, this explanation works only if we assume that all firms face approximately the same marginal tax rate, and that is an assumption we can immediately reject. The extensive trading of depreciation tax shields and investment tax credits through financial leases and other devices proves that plenty of firms face low marginal tax rates. Given significant differences in effective marginal tax rates, and given that the static trade-off theory works, we would expect to find a strong tax effect in any cross-sectional test, regardless of those theory of debt and taxes you believe. Given significant differences in effective marginal tax rates, and even that the static trade-off theory works, we would expect to find a strong tax effect in any cross-sectional test, regardless of those theory of debt and taxes you believe. Figure 2 plots the net tax gain from corporate borrowing against the expected realizable tax shield from the future deduction of $1 of interest paid. For some firms, this number is 46 cents or close to it. At the other extreme, there are firms with large unused loss carry-forwards which pay no immediate taxes. An extra dollar of interest paid by these firms would create only a potential future deduction usable when and if the firm earns enough to work off prior carry-forwards. The expected realizable tax shield is positive but small. Also, there are firms paying taxes today which cannot be sure that they will do so in the future. Such a firm values expected future interest tax shields at somewhere between 0 and the full statutory tax rate. In the corrected theory, any tax-paying corporation gains by borrowing. The greater the marginal tax rate, the greater the gain. This gives the top line in the figure. In Miller's theory, the personal income taxes on interest payments would exactly offset the corporate interest tax shield provided that the firm pays the full statutory tax rate. However, a firm paying a lower rate would see a net loss to corporate borrowing and a net gain to lending. This gives the bottom line. There are also compromise theories advanced by D'Angelo and Masullis, Modigliani and others, indicated by the middle dashed line in the figure. The compromise theories are appealing because they seem less extreme than either the or Miller theories. But regardless of which theory holds, the slope of the line is always positive. The difference between one, the tax advantage of borrowing to firm facing full statutory rate, and the two, the tax advantage of lending, or at least not borrowing to firms with large tax loss carry forwards, is exactly the same as the extreme theories. Thus, although the theories tell different stories about aggregate supply and demand of corporate debt, they make essentially the same prediction about which firms borrow more or less than average. So the tax side of the static trade-off theory predicts that IBM should borrow more than Bethlehem Steel, other things equal, and that General Motors' debt to value ratio should be more than Chrysler's. Cost of financial distress. Costs of financial distress include the legal and administrative cost of bankruptcy, as well as the subtler agency, moral hazard, monitoring, and contracting cost, which can erode firm value even if formal default is avoided. We know these costs exist, although we may debate whether their magnitude. For example, there is no satisfactory explanation of debt covenants unless agency costs and moral hazard problems are recognized. The literature on cost of financial distress supports two qualitative statements about financing behavior. One, risky firms ought to borrow less, other things equal. Here, risk would be defined as the variance rate of the market value of the firm's assets. The higher the variance rate, the greater the probability of default on any given package of debt claims. Since costs of financial distress are caused by threatened or actual default, safe firms ought to be able to borrow more before expected cost of financial distress offset the tax advantage of borrowing. Firms holding tangible assets in place, having active second-hand markets, will borrow less than firms holding specialized intangible assets or valuable growth opportunities. The expected cost of financial distress depends not just on the probability of trouble, but the value lost if trouble comes. Specialized intangible assets or growth opportunities are more likely to lose value in financial distress. The pecking order theory contrasts the static trade-off theory with competing popular story based on a financing pecking order. firms prefer internal finance, number one. Number two, they adapt their target dividend payout ratios to their investment opportunities, although dividends are sticky and target payout ratios are only gradually adjusted to shifts in the extent of valuable investment opportunities. Three, sticky dividend policies plus unpredictable fluctuations in profitability and investment opportunities mean that internally generated cash flow may be more or less than investment outlays. If it is less, the firm first draws down its cash balance or marketable securities portfolio. Number four, if external finance is required, firms issue the safest security first. That is, they start with debt, then possibly hybrid securities such as convertible bonds, and perhaps equity as a last resort. In this story, there is no well-defined target debt equity mix because there are two kinds of equity, internal and external, one at the top of the pecking order and one at the bottom. Each firm's observed debt ratio reflects its cumulative requirements for external finance. The pecking order literature. The pecking order hypothesis is hardly new. For example, it comes through loud and clear in Donaldson's 1961 study of the financial practices of a sample of large corporations. He observed that management strongly favored internal generation as a source of new funds, even to the exclusion of external funds, except for occasional unavoidable bulges in the need for funds. These bulges were not generally met by cutting dividends. Reducing the customary cash dividend payments was unthinkable to most management, except as a defensive measure in a period of extreme financial distress. Given that external finance was needed, managers rarely thought of issuing stock. Though few companies would go so far as to rule out a sale of common under any circumstances, the large majority had not had such a sale in the past 20 years and did not anticipate one in the foreseeable future. This was particularly remarkable in view of the very high price-earnings ratio of recent years. Several financial officers showed that they were well aware that this had been a good time to sell common, but the reluctance still persisted. Of course, the pecking order hypothesis can be quickly rejected if you require it to explain everything. There are plenty of examples of firms issuing stocks when they could issue investment grade debt. But when one looks at aggregates, the heavy reliance on internal finance and debt is clear. For all non-financial corporations over the decade 1973 to 82, internally generated cash covered, on average, 62% of capital expenditures, including investment in inventory and other current assets. The bulk of the required external financing came from borrowing. Net new stock issues were never more than 6% of external financing. Anyone innocent of modern finance who looked at these statistics would find the pecking order idea entirely plausible, at least as a description of typical behavior. Writers on managerial capitalism have interpreted firms' reliance on internal finance as a byproduct of the separation of ownership and control. Professional managers avoid relying on external finance because it would subject them to the discipline of the capital market. Donaldson's 1969 book was not primarily about managerial capitalism, but he nevertheless observed that the financing decisions of the firms he studied were not directed towards maximizing shareholder wealth, and that scholars attempting to explain those decisions would have to start by recognizing the managerial view of corporate finance. This conclusion is naturally given the state of finance theory in the 1960s. Today, it is not obvious that financing by a pecking order goes against the shareholders' interest. External financing with asymmetric information. I used to ignore the pecking order story because I could think of no theoretical foundation for it that would fit in with the theory of modern finance. An argument could be made for internal financing to avoid issue costs, and if external finance is needed for debt to avoid the still higher cost of equity, but issue costs in themselves do not seem large enough to override the cost and benefit of leverage emphasized in the static trade-off theory. However, recent work based on asymmetric information gives predictions roughly in line with the pecking order theory. The following brief exposition is based on a forthcoming joint paper by me and Nicholas Majlov, although I will here boil down that paper's argument to absolute essentials. Suppose the firm has to raise N dollars in order to undertake some potentially valuable investment opportunity. Let Y be this opportunity's net present value, NPV, and X be what the firm will be worth if the opportunity is passed by. The firm's manager knows that X and Y are, but investors in capital market do not. They see only a joint distribution of possible values X tilde and Y tilde. The information asymmetry is taken as given. Aside from the information asymmetry, capital markets are perfect and semi-strong form efficient. MM's proposition 1 holds in the sense that the stock of debt relative to real assets is irrelevant if information available to investors is held constant. The benefit of raising N dollars by a security issue is Y, the NPV of the firm's investment opportunity. There is also a possible cost. The firm may have to sell the securities for less than they are really worth. Suppose the firm issues stock with an aggregate market value when issued of N. I will consider that issue in a moment. However, the manager knows the shares are really worth N sub 1. That is, N sub 1 is what the new shares will be worth. Other things equal, when investors acquire the manager's special knowledge. Majlov and I discussed several possible objectives managers would pursue in this situation. The one we think makes the most sense is maximizing the true or intrinsic value of the firm's existing shares. That is, the manager worries about the value of the old shareholders' stake in the firm. Moreover, investors know the manager will do this. In particular, the new investors who purchase any stock issue will assume that the manager is not on their side and will rationally adjust their price they are willing to pay. Define delta N as the amount by which the shares are over or undervalued, delta N being equal to N sub 1 minus N. Then the manager will issue and invest when Y being equal to or greater than or equal to delta N. If the manager's insider information is unfavorable, delta N is negative and the firm will always issue, even if the only good use of the funds raised is to put them in the bank, a zero NPV investment. If the inside information is favorable, however, the firm may pass up a positive NPV investment opportunity rather than issue undervalued shares. But if management acts this way, its decision to issue will signal bad news to both old and new shareholders. Let V be the market value of firm, price per share times the number of shares. It does not issue, and V dash would be market value if it does issue. V dash includes the value of the newly issued shares. Thus, if everyone knows that managers will act according to inequality 1, the conditions for a rational expectations equilibrium are V being equal to the expected value of x tilde given no issue, which is equal to expected value of x tilde given y being less than delta n. V dash being equal to expected value of x tilde plus y tilde plus n given issue is equal to expected value of x tilde plus y tilde plus n given y being greater than or equal to delta n. The total dollar amount raised is fixed by assumption, but the number of new shares needed to raise that amount is not. Thus, delta n is endogenous. It depends on V prime. For example, if the firm issues, the fraction of all shares held by new stockholders is n divided by V dash. The manager sees the true value of their claim as n sub 1 being equal to n over V prime times x plus y plus n. Thus, given n, x and y, and given that stock is issued, the greater the price per share, the less value is given up to new stockholders, and the less delta n is. Majlov and I have discussed the assumptions and implications of this model in considerable detail. But here are the two key points. Number 1, the cost of relying on external financing. We usually think of the cost of external finance as administratively an underwriting cost, and in some cases, underpricing of the new securities. Asymmetric information creates the possibility of different sort of cost. The possibility that the firm will choose not to issue and will therefore pass up a positive NPV investment. The cost is avoided if the firm can retain enough internally generated cash to cover its positive NPV opportunities. Number 2, the advantages of debt over equity issues. If the firm does seek external funds, it is better off issuing debt than equity securities. The general rule is issue safe securities before risky ones. This second point is worth explaining further. Remember that the firm issues and invests if y, the NPV of its investment opportunity, is greater than or equal to delta n, the amount by which the new shares are undervalued if delta n is greater than 0, or overvalued if delta n is less than 0. For example, suppose the investment opportunities n being equal to $10 million, but in order to raise that amount of the firm must issue shares that are really worth $12 million. It will go ahead only if project NPV is at least $2 million. If it is worth only $1.5 million, the firm refuses to raise the money for it. The intrinsic overall value of the firm is reduced by $1.5 million, but the old shareholders are $0.5 million better off. The manager could have avoided this problem by building up the firm's cash reserves, but that is hindsight. The only thing he can do now is to redesign the security issue to reduce delta n. For example, if delta n could be cut to $0.5 million, the investment project could be financed without diluting the true value of existing shares. The way to reduce delta n is to issue the safest possible securities. Strictly speaking, securities whose future value changes least when the manager's inside information is revealed to the market. Of course, delta n is endogenous, so it is loose talk to speak of the manager controlling it. However, there are reasonable cases in which the absolute value of delta n is always less for debt than for equity. For example, if the firm can issue default risk-free debt, delta n is 0, and the firm never passes up a value of investment opportunity. Thus, the ability to issue default risk-free debt is as good as cash in the bank. Even if default risk is introduced, the absolute value of delta N will be less for debt than for equity if we make the customary assumptions of option pricing model. Thus, if the manager has favorable information, delta N being equal to or greater than 0, it is better to issue debt than equity. This example assumes that new shares or risky debt would be underpriced. What if the manager's inside information is unfavorable so that any risky security issue would be overpriced? In this case, wouldn't the firm want to make delta N as large as possible to take maximum advantage of new investors? If so, stock would seem better than debt, and warrants better still. The decision rule seems to be issue debt when investors undervalue the firm and equity, or some other risky security when they overvalue it. The trouble with this strategy is obvious once you put yourself in investors' shoes. If you know the firm will issue equity only when it is overpriced and debt otherwise, you will refuse to buy equity unless the firm has already exhausted its debt capacity. That is, unless the firm has issued so much debt already that is would face substantial additional cost in issuing more. Thus, investors would effectively force the firm to follow a pecking order. Now, this is clearly too extreme. The model just presented would need lots of fleshing out before it could fully capture actual behavior. I have presented it just to show how models based on asymmetric information can predict the two central ideas of pecking order story. First, the preferences for internal finance, and second, the preference for debt over equity if external financing is sought. What we know about corporate financing behavior. I will now list what we know about financing behavior and try to make sense of this knowledge in terms of the two hypotheses sketched above. I begin with 5 facts about financing behavior and then offer a few generalizations from weaker statistical evidence or personal observation. Of course, even facts based on apparently good statistics have been known to melt away under further examination, so read with caution. Internal versus external equity. Aggregate investment outlays are predominantly financed by debt issues and internally generated funds. New stock issues play a relatively small part. Moreover, as Donaldson has observed, this is what many managers say they are trying to do. This fact is what suggested the pecking order hypothesis in the first place. However, it might also be explained in a static trade-off theory by adding significant transaction cost of equity issues and noting the favorable tax treatment of capital gains relative to dividends. This would make external equity relatively expensive. I would explain why companies keep target dividend payouts low enough to avoid having to make regular stock issues. It would also explain why a firm whose debt ratio soars above target does not immediately issue stock, buy back debt, and re-establish a more moderate debt-to-value ratio. Thus, firms might take extended excursions above their debt targets. Note, however, that the static trade-off hypothesis, as usually presented, rarely mentions this kind of adjustment cost. But the out-of-pocket cost of repurchasing shares seems fairly small. It is thus hard to explain extended excursions below a firm's debt target by an augmented static trade-off theory. The firm could quickly issue debt and buy back shares. Moreover, if personal income taxes are important in explaining firms' apparent preferences for internal equity, then it's difficult to explain why external equity is not strongly negative. that is, why most firms haven't gradually moved to materially lower target payout ratios and used the released cash to repurchase shares. Timing of security issues. Firms apparently try to time stock issues when security prices are high, given that they seek external finance. They are more likely to issue stock rather than debt after stock prices have risen than after they have fallen. For example, past stock price movements are one of the best performing variables in Marsh's study of British firms' choices between new debt and new equity issues. Taggart and others have found similar behavior in the United States. This fact is embarrassing to static trade-off advocates. If firm value rises, the debt to value ratio falls, and firms ought to issue debt, not equity, to rebalance their capital structures. The fact is equally embarrassing to the pecking order hypothesis. There is no reason to believe that the manager's inside information is systematically more favorable when the stock prices are high. Even if there were such a tendency, investors would have learned it by now and would interpret the firm's issue decision accordingly. There is no way firms can systematically take advantage of purchases of new equity in rational expectations equilibrium. Borrowing against intangibles and growth opportunities. Firms holding valuable intangible assets or growth opportunities tend to borrow less than firms holding most tangible assets. For example, Long and Malitz found a significant negative relationship between rates of investment in advertising and research and development and the level of borrowing. They also found a significant positive relationship between the rate of capital expenditure and the level of borrowing. Williamson reached the same conclusion by a different route. His proxy for a firm's intangibles and growth opportunities was the difference between the market value of its debt and equity securities and the replacement cost of its tangible assets. The higher this proxy, he found, the less the firm's debt-to-value ratio. There is plenty of indirect evidence indicating that the level of borrowing is determined not just by the value of risk of the firm's assets, but also by the type of assets it holds. For example, without this distinction, the static trade-off theory would specify all target debt ratios in terms of market, not book values. Since many firms have market values far in excess of book values, even if those book values are restated in current dollars, we ought to see at least a few such firms operating comfortably at very high book debt ratios. And of course, we do not. This fact begins to make sense, however, as soon as we realize that book values reflect assets in place, tangible assets, and working capital. Market values reflect intangibles and growth opportunities as well as assets in place. Thus, firms do not set target book debt ratios because accountants certify the books. Book asset values are proxies for the values of assets in place. Exchange offers. Masulis has shown that stock prices rise on average when a firm offers to exchange debt for equity and fall when they offer to exchange equity for debt. This fact could be explained in various ways. For example, it might be a tax effect. If most firms' debt ratios are below their optimal ratios, and if corporate interest tax shields are significant positive value, the debt for equity exchange would tend to move firms closer to optimum capital structure. Equity for debt swaps, would tend to move them farther away. The evidence on the exchanges hardly builds confidence in the static trade-off theory as a description of financing behavior. If the theory were right, firms would be sometimes above and sometimes below their optimal ratios. Those above would offer to exchange equity for debt. Those below would offer debt for equity. In both cases, the firm would move closer to the optimal. Why should an exchange offer be good news for in one direction and bad news if in the other? As Masoulis points out, the firm's willingness to exchange debt for equity might signal that the firm's debt capacity had, in management's opinion, increased. That is, it would signal an increase in firm's value or a reduction in firm's risk. Thus, a debt for equity exchange would be good news and the opposite exchange bad news. This information effect explanation for exchange offers is surely right in one sense. Anytime an announcement affects stock price, we can infer that the announcement conveyed information. This is not much help That is not much help except to prove that the managers have some information investors do not have. The idea that an exchange offer reveals a change in the firm's target debt ratio and thereby signals changes in firm value or risk sounds plausible, but an equally plausible story can be told without saying anything about the target debt ratio. If the manager with superior information acts to maximize the intrinsic value of existing shares, then the announcement of a stock issue should be bad news, other things equal, because stock issues will be more likely when the manager receives bad news. On the other hand, stock retirements should be good news. The news in both cases has no evident necessary connection with shifts in target debt ratios. It may be possible to build a model combining asymmetric information with the cost and benefits of borrowing emphasized in static trade-off theories. My guess, however, is that it will prove difficult to do this without also introducing some elements of the pecking order story. Issue or repurchase of shares. The fifth fact is no surprise given the fourth. On average, stock price falls when firms announce a stock issue. Stock prices rise, on average, when a stock repurchase is announced. This fact has been confirmed in several studies, including those by Korvar, Asquith, and Mullins, Dannen, Michelson, Vermeulen, and D'Angelo and Rice. This fact is, again, hard to explain by a static trade-off model, except an information effect in which stock issues or retirements signal changes in the firm's target debt ratio. I've already commented on that. The simple asymmetric information model I used to motivate the pecking orders hypothesis does predict that the announcement of stock issue will cause the stock price to fall. It also predicts that stock price should not fall, other things equal, if default risk debt is issued. If, of course, no private company can issue debt that is absolutely protected from default, but it seems reasonable to predict that the average stock price impact of high-grade debt issue will be small relative to average impact of stock issues. This is what Dan and Michelson find. These results may make one a bit more comfortable with asymmetric information models of the kind sketched above, and thus a bit more comfortable with the pecking order story. That is the 5 facts. That's the 5 facts. Here now are 3 items that do not qualify for that list. Just call them observations. Existence of target ratios. Marsh and Taggart have found some evidence that firms adjust towards a target debt ratio, debt to value ratio. However, A model based solely on this partial adjustment process would have a very low R squared. Apparently, the static trade-off model captures only a small part of actual behavior. Risk. Risky firms tend to borrow less, other things equal. For example, both Long and Malitz and Williamson found significant negative relationships between unlevered betas and the level of borrowing. However, the evidence of risk and debt policy is not extensive enough to be totally convincing. Taxes. I know of no study clearly demonstrating that a firm's tax status has predictable material effects on its debt policy. I think the wait for such a study will be protracted. Admittedly, it's hard to classify firms by tax status without implicitly classifying them on other dimensions as well. For example, firms with large tax loss carry-forwards may also be firms in financial distress, which have high debt ratios almost by definition. Firms with high operating profitability and therefore plenty of unshielded income may also have valuable intangible assets and growth opportunities. Do they end up with a higher or lower than average debt to value ratio? Hard to say. Conclusion. People feel comfortable with the static trade-off story because it sounds plausible and yields an interior optimum debt ratio. It rationalizes moderate borrowing. Well, the story may be moderate and plausible, but that does not make it right. We have to ask whether it explains firms' financing behavior. If it does, fine. If it does not, then we need a better theory before offering advice to managers. The static trade-off theory works to some extent, but it seems to have an unacceptably low R squared. Actual debt ratios vary widely across apparently similar firms. Either firms take extended excursion from their targets, or the targets themselves depend on factors not yet recognized or understood. At this point, we face a tactical choice between two research strategies. First, we could try to expand the static trade-off story by introducing adjustment cost, possibly including those stemming from asymmetric information and agency problems. Second, we could start with a story based on asymmetric information and expand it by adding only those elements of the static trade-off which have clear empirical support. I think we will progress faster by the latter route. Here is what I really think is going. I warn you that the following modified Pecking order story is grossly oversimplified and underqualified, but I think it is generally consistent with the empirical evidence. 1. Firms have good reasons to avoid having to finance real investment by issuing common stock or other risky securities. They do not want to run the risk of falling into the dilemma of either passing by positive NPV projects or issuing stocks at a price they think it is too low. Number 2, they set target dividend payout ratios so that normal rates of equity investments can be met by internally generated funds. Number 3, the firm may also plan to cover parts of normal investment outlays with new borrowing, but it tries to restrain itself enough to keep the debt safe. That is, reasonably close to default risk-free. It restrains itself for 2 reasons. First, to avoid any material cost of financial distress. And second, to maintain financial slack in the form of reserve borrowing power. Reserve borrowing power means that it can issue safe debt if it needs to. Number 4, since target dividend payout ratios are sticky and investment opportunities fluctuate relative to internal cash flow, The firm will from time to time exhaust its ability to issue safe debt. When this happens, the firm turns to less risky securities first. For example, risky debt or convertibles before common stock. The crucial difference between this and the static trade-off theory is that in the modified pecking order story, observed debt ratios will reflect the cumulative requirement for external financing, a requirement accumulated over extended period. For example, think of an unusually profitable firm in an industry generating relatively slow growth. That firm will end up with an unusually low debt ratio compared to its industry's average, and it won't do much of anything about it. It won't go out of its way to issue debt and retire equity to achieve a more normal debt ratio. An unprofitable firm in the same industry will end up with a relatively high debt ratio if it is high enough to create significant cost of financial distress. The firm may rebalance its capital structure by issuing equity. On the other hand, it may not. The same asymmetric information problems, which sometimes prevent a firm from issuing stock to finance real investment, will sometimes also block issuing stock to retire debt. If this story is right, average debt ratios will vary from industry to industry because asset risk, asset type, and requirements for external funds also vary by industry. But a long-run industry average will not be a meaningful target for individual firms in that industry. Let me wrap this up by noting the two clear gaps in the description of what is really going on. First, the modified pecking order story depends on sticky dividends, but does not explain why they are sticky. Second, it leaves us with at best a fuzzy understanding of when and why firms issue common equity. Fortunately, I have nothing to say on the first weakness, and only the following brief comments on the second. The modified pecking order story recognizes both asymmetric information and cost of financial distress. Thus, the firm faces two increasing costs as it climbs up the pecking order. It faces higher odds of incurring cost of financial distress and also higher odds that future positive NPV projects will be passed by because the firm will be unwilling to finance them by issuing common stock or other risky securities. The firm may choose to reduce these costs by issuing stock now, even if new equity is not needed immediately to finance real investment, just to move the firm down the pecking order. In other words, financial slack, liquid assets, or reserve borrowing power is valuable, and the firm may rationally issue stock to acquire it. I say may, because the firm which issues equity to buy financial slack faces the same asymmetric information problems as a firm issuing equity to finance real investment. The optimal dynamic issue strategy for the firm under asymmetric information is, as far as I know, totally unexplored territory.